It's 5:30 p.m. here.
Yeah, this is a good. Oh, note.
Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Wednesday, March 29th, nearly the official end of the first quarter. Everything's changed so much, it's back to nearly feels like the same. We have the A-Star, what was that program? I forget it now. The team that drove around in the big black van, the A-Team. Was that what it's called? It was the A-Team.
It was the
well,
A-Team,
yeah, it was the A-Team. Okay, somewhere in my scratchy memory is something called the A-Team and Mr. Hutch or Mr. Hulk or whatever his name was. But nonetheless, things change so much. They remain the same, with Brent crude oil trading now above $79 a barrel, up a 0.5% this morning in early Asian trade, a sense of optimism returning to the markets. Peter, has this so-called banking crisis now passed?
Well, Sean, good morning or good evening from wherever you are, and greetings from Sydney. I don't know whether it's past, Sean, but it seems to have lost a little bit of momentum in the last, say, 24 to 48 hours across Main Street and probably Wall Street, and what we experienced last week on Friday with Deutsche Bank and so on. So that really, I think, hit everyone between the eyes and the uneasiness. But I've got to say, crude has been strongly bid up since really sometime Monday, and it's been a big push up. And you know where we sit now at 79 and change for Brent, as you mentioned. I got WTI nearly 74. It's been a strong belief. We've seen those lows, and this month has been quite extraordinary from those highs that we saw on the 6th of the month. Then it collapsed of St. Patrick's Day, and we've had a nice bounce since then. So maybe it's onward and upward for the rest of the week, Sean.
Ole Hansen, head commodity strategy at Saxo Bank. The same to you. I mean, way out in Australia, as you're about to just go for a swim on the beach, a European banking crisis probably seems like somebody's on Mars. But in Europe, ultimately, as Peter referenced, we had Credit Suisse, didn't wobble, it collapsed, or practically collapsed, saved before it drowned. And then Deutsche Bank had a fairly significant wobble last Friday. That seems to have been tamed. Your thoughts, Ole Hansen, as regards this end of first quarter? Are we at the end of this so-called banking crisis and its ramifications for Europe?
Good morning. Probably not quite yet, but I think what we've seen subsequently is really a market that just having a second thought about this sell-off. There was a lot of panic. There's no doubt that we're struggling in the aftermath of these succession of rate hikes that has really uprooted some of the market, especially the bond market, and that's creating these problems. But I think looking at the Deutsche Bank as such, it's a sound bank, and we should see some normalization start to return, and with that, obviously also the bounce we've seen in the crude oil market. But what I think also, just talk about the crude oil and the sell-off we had, we came out of a 4 months period where the market has been range bound. Volatility had come down to the lowest we've seen for a while. If you are a speculative hedge fund, you're adjusting your positions according to the volatility. So as markets went range bound, they increased their exposure, especially on the long side, because there was backwardation in Brent. As the floodgate opened and we broke below 80, that triggered a massive amount of selling. Traders looking for new momentum to the downside. That failed to materialize, and they're suffering the consequences of that right now. So for now, it's primarily, I think, a short covering bounce that we've seen. Obviously, also some hedging coming in at these lower levels, but generally just highlights once again how speculative interest in the market have quite an outsized market reaction.
Neil Atkinson, former head of oil markets division at the IEA. Neil, ultimately, at the end of the day, there's no shortage of oil around. We had the Russian energy minister overnight, Energy Minister Nikolai Shuginov, if I ever get his name pronounced right. But nonetheless, Russian oil has successfully redirected all of its cargoes through the first quarter. the supply, there's no supply crunch, and hence oil prices are sort of recovering back to their sweet spot of $80 on Brent. Where do you see the balance market supply demand at the moment?
Well, one of the things that we've learned a year and a bit on from the Russian invasion of Ukraine is that the apocalyptic warnings that were made by many people in the market, and I put my hands up to some extent here, not apocalyptic necessarily, but the warnings that Russian supply of crude and products would fall significantly have not yet come to pass. We've seen that obviously it took time to get sanctions regimes in place. And we've seen that with the price cap mechanisms, there is obviously the legal possibility for Russia still to export large volumes. And indeed, there are large volumes being exported, whether illegally, however you want to call it, large volumes of Russian oil still on the water in dodgy ships, which don't necessarily have end users. But the point that you make is there is still plenty of supply out there, and it's not expected to drop significantly in the near future. So if you've got a reasonable degree of security as far as supply is concerned, the other side of the balance is obviously demand. And of course, we're all looking at China because China's coming out of COVID, it's rebounding. We don't yet know exactly how strong that rebound is going to be, but it's still going to be significant. And that to me is the great uncertainty, because when I was in London for the Institute of the IP Week, as I continue to insist on calling it, the range of estimates amongst some very reputable analysts for whom I have great respect as to how strong global oil demand growth is going to be this year, that range was extraordinary. From the institutions, IEA, OPEC, the EIA, down to some of the private analysts, it was as much as 700,000 or 800,000 barrels a day difference between their expectations of demand growth. And when
they were all loaded to the end of the year, so there would have to be a dramatic shift in the third and fourth quarter.
Yeah, but it's very unusual. We know we're now at the end of the first quarter, as you said in your introduction, to have that range of estimates and where we're already well into the year is actually it's quite unusual. But we'll obviously have to see as the real data comes in and we get a clearer picture of what is actually happening on the ground. We may, I suspect, start to rein in to some extent some of those, perhaps some of the more optimistic outlooks for demand growth. So if you've got plenty of Russian oil continuing to be in the market, and maybe the demand growth outlook isn't quite as rosy as some people think, but still okay, then I think we are in for a situation of a relatively range-bound, comfortable market.
Peter, perhaps you can shed us some light from your perspective on China's recovery, reopening. The first quarter, generally the tone has been, as expected, I suppose, relatively moderate. What's your outlook for China? Would you concur with that, the thesis and its outlook going forward?
Well, Sean, we understand where it's situated at the moment. I'm looking at it from an iron ore perspective domestically here, of course, and there's been a move to the upside a little bit as far as base metals. But when I look at the China situation, I think the second quarter, they're going to come out of the blocks even harder, and leading into the third quarter, I think relatively strong growth, domestic demand, and I wouldn't be surprised that they'll try and export their way out of any internal issues that they have. The property sector is still a work in progress, and how government's going to manage those expectations. So as we sit here, one would hope that they continue their demand picture across energy, coal, and the consumption across for base metals. So the overall theme, I think, is onward and upward for the Chinese, and relatively good health overall for their economy.
As just to follow up on that, Peter, obviously Australia and Jack Ma had a similar experience over the last few years with sort of this wrong side of China's strict kind of behave yourself policy. We're now seeing Jack Ma back in China, back in the news with some big news about the breakup of of his company by their design
Yeah.
or by default. Your thoughts on this new face? Is this a new face? Is it is this a new dawn for that sort of attitude towards China reopening, being more business friendly and so forth?
Well, I would think so, Sean. I mean, it's pretty tough last couple of years for China when you're looking at it. And we understand from the property side, from COVID and all those mechanisms that we needed to basically put to bed. They've come out the other side and they're looking for growth. I understand the Jack Ma situation. We're a proxy in a lot of ways, the Aussie dollar, and it's still languishing at 66 cents. So there hasn't been a lot of, whipsawing that we've seen with other markets like yen or certainly with the euro or pound. So I would hope that we see some good news continuing to flow from China and the good storyline that'll back our commodity-driven economy to, some relatively good strength for the Aussie and for our economy.
Ole, I wanted to sort of dig a little bit into the kind of Russian energy exports and where Europe is sort of on that and where the outlook goes. There is reports overnight of the European Union countries agreeing to seek a legal option to stop Russian companies sending LNG to the European Union. It's like, you're going to get out and kind of put a hand that the fact that they have to try and stop them. It's rather amazing to think that they've gone to these dramatic lengths to cut off pipeline gas, and yet LNG gas from Russia has grown substantially across 2022 into Europe. Where do you see the outlook for that and other Russian exports, oil and liquids, in the second quarter?
Well, I think as Neil said earlier, there's a lot of oil now sitting on ships, still not looking, having found a home. So I think we've probably not, we haven't seen the full story yet whether Russia is going to continue to uphold its exports to the extent that they have so far during the first quarter. So I think that remains to be seen. But there's no doubt on the fuel side, Europe is looking elsewhere right now, and Russia is taking its ships on longer journeys to deliver it in Asia and Middle East and so on. Regarding the gas, it is a whack-a-mole story. Where they have managed to continue to export and as you say, it's strange. They cut the pipelines, but at the same time they increase LNG, and it makes sense right now with Europe having added the additional ability to import LNG. It obviously makes sense that those LNG import terminals are not going to be used for Russian ships offloading, but we'll get the gas from somewhere else. But how they solve that remains to be seen, because it seems like most of the LNG that is coming out of Russia has been delivered to ports in southern Europe. So we'll have to see how they respond to it.
On that point, Neil, I mean, it's increasingly strikes me that we've got a lot of smoke and mirrors over the last year, and we should all just sort of basically come to the realization that there's no intention or by anyone anywhere to stop the flow of energy in this Ukraine crisis. The price cap was some sort of disguise of being perceived to do something to allow Russian oil to flow. Gas with pipeline, obviously limitations, but your sense that from a market point of view, that none of these are actually actions in which to constrict Russian exports?
We all know that the importance of Russian energy exports is enormous. And, we saw what happened with prices in the early part of the reaction to the Russian invasion of Ukraine. Incredible though it now seems, we had oil up to nearly $140 a barrel briefly. We've had gas prices going through the roof. We've had, mercifully here in Europe, we had a mild winter, so some of the more apocalyptic forecasts didn't come to pass. We recognize that although there is a great deal we can do to reorganize our trading system to use other supplies and reduce our reliance on Russian supplies, it is still a preferable source of energy. There's no getting away from that. And the price cap mechanism recognizes that. So, whack-a-mole, as Ollie said. That's actually quite a good way of describing it. But Europe needs to be very careful, because although the mild winter left gas stocks at the end of the winter season in a pretty healthy state, and it's pretty easy to see how they can be rebuilt by late October, early November for the 23-24 heating season. If we were to get a really cold winter, which it must be possible. I mean, nobody knows what the weather will be. But if we were to get a very, very cold winter and we were to use up vast amounts of gas, we're in a situation where we would have to cut off supplies to industry to make sure domestic households supplies were maintained. Then moving into 2024, which people must already be looking at from a planning perspective, Europe is still in a very vulnerable situation. So as far as energy supplies are concerned, and Russia is allowed to export under certain tough conditions, and it will do so where that is within its interests. It will continue to maximize its sales to China, to India, to anybody else who doesn't care about the sanctions or is indifferent to them. And I think we're in for a long slog.
But Neil, just to follow up on that, I mean, these sort of big trend narratives that we've been tracking, obviously the Russia's war in Ukraine and its impact on global energy supplies, etc. I'm wondering, from your perspective, are we slowly but surely migrating back to the good old-fashioned inventories are up, inventories are down? There's a disruption in France because a strike in an LNG facility has been shut. So we're going to moderate a little price up, a little price down. So we're back to basics rather than markets being moved by massive trends.
Yeah, sure. And ultimately, it's always the fundamentals that count. We can pontificate about the geopolitical issues all we like, and that's important, of course. But ultimately, it's how the trading system and the supply-demand mechanics adjust to changing circumstances. And so far, they've managed to adjust pretty well. But, we've seen a big substitution of Russian gas by LNG from, amongst other places, the United States. I mean, 'tis a great day to be alive if you're a US LNG exporter. But, we can't be sure that there's going to be the availability of ever increasing volumes of LNG from places like the US and elsewhere, partly because the liquefaction facilities aren't there, and there isn't necessarily the regasification capacity in Europe, plus the fact that Europeans might find this rather horrific. There are other people in this world that need LNG, developing economies in Asia. So there's still a big dynamic out there, and it is these fundamentals of the demand from Europe and elsewhere, and the fundamentals of supply, who has got more LNG if we can't have Russian gas, that is going to drive the market.
Let's go to the survey question, which is just sort of addressing the initial point this morning. If indeed, has the so-called banking crisis now passed? Yes or no? Brave sort of maybe might be the third option there, but not available. Peter, one of the big trend lines, of course, that we have been talking about for a long time and is obviously tied into that so-called banking crisis and some element of being the trigger of it, i.e. higher interest rates, rapidly rising interest rates. We saw during the red hot center of this recent sort of banking trauma, the ECB raised 50 basis points, the Fed raised 25. Where are we at with that cycle, and where are we at with its impact for the markets, do you think?
Well, Sean, just on that, the Aussies, we released our numbers this afternoon, and it looks like it's going to be a relatively, it was more comfortable. I'm not saying that it was anything really that joyous, but it didn't go up.
Australian inflation numbers, basically, you're saying.
Yes, that came through in the last couple of hours, not like what the POMs did last week. So that was a good sign. Now, as far as Jay Powell and his gang, I'm waiting for that PCE inflation data to drop and what happens there. So I think it all hinges, Sean, on what happens with the data. If the data surprises to the upside and it's like the POMs, then I think Jay Powell is onward and upward. And if it's like Australia, and that's the other side of the coin, then there could be a handbrake there, and we may not see a rate rise for maybe a month or two from Jay Powell until it gets a better picture as far as the domestic scene in the States. The silent one is from energy prices. If they continue to climb, then that's not a good sign for Jay Powell and his gang. So we've just got to work through that and see the impact both domestically in the States.
But all
US
being
dollar
said,
index.
all being said and done on that, Peter, the another piece, another incremental piece, or not? I mean, the recent trauma of the banking sector has kind of accelerated our arrival at some element of the end of the tightening, whether it's another bit here, another bit there. But the big question seems to be we're left with after this recent trauma is the market predicting a rapid reversal of rates. Not the long hold and pause thing, but now it's, cuts just around the corner. Your thoughts on that as an outlook and what its implications could be for the energy markets?
Well, you see that, Sean. I mean, some of the analysts you listen to, we're saying fourth quarter, you're going to see a big pullback as far as rates. And then you've got another camp out there that are saying it's going to be a continuation to the upside. So we've just got to, again, time is going to be the best friend that we've got to live through this and just see how it all drops. As far as energy, well, I'm sitting here, won't be surprised. I think what we saw in the last couple of weeks was the low for possibly the year. And I'm going to probably suggest maybe 85 to 90 is going to be where we're heading for Brent in the short run, probably by end of April. So it seems to be onward and upward at the moment. That's our viewpoint. And it's one of, let's see where May and June go. But I think there's a lot of issues that have to be worked through yet to get a clean bill of health as we run into third and fourth quarter.
Ole, can we draw any guidance or cuckoo in the coal mine, no pun intended, from any other of the commodities that you're tracking? I mean, we've saw gold in the last month sort of be a signal of stress as it sort of touched on $2,000 an ounce. Are you seeing anything else in the other commodity complexes that gives some guidance as to where the direction of travel may be in the second quarter?
Well, I think generally they are indicating that we will see some recovery coming into the market, and I think also it was interesting to note that crude oil really was the one that took the brunt of the beating during the past few weeks. And I think, again, as I mentioned at the start, I think a lot of that has to do with positioning, simply a lot of position being caught offside by that sudden move. If you look at the industrial metals sector, that's really still recovering quite decently from the pickup in China. We see the green transformation supporting copper. I mean, we're getting more and more stories about the copper stocks going to be depleted within the next 12 months. And that is obviously adding some underlying support. But I think gold is probably a good guide right now. And as you say, Sean, we got rejected above 2,000 last week. We're now hovering a bit lower, but the markets were nervous right now simply because we've gone from pricing in a 1% rate hike. We got 25 of those, 25 basis points of those, to now predicting or pricing in 125 basis point cut over the next 12 months. There's simply a massive gap between where the FOMC has left us and where the market is telling the FOMC to go. And as long as once we get that gap narrowed in either direction, we'll probably continue to see some volatility.
Do you have any sense who wins that tug of war, Ole?
Well, the incoming data from the US now is once again going to be very important. And you asked the question before whether the banking crisis is over. I said no, not the fact that I think the banking crisis is. I think that one is probably over, but the stress is going to move to other sectors. We'll see that over the coming weeks and quarter weeks and months, and that's really into private equity and into the retail sector, which has been benefiting greatly from zero interest rates for a decade, and they're now suffering the consequence from this rapid rising rates.
Neil, I wanted to get your thoughts on the announcement over the last few days. I mean, where the US is in replenishing its inventories, its strategic petroleum reserve. Your former head of oil markets at Energy at the IEA, and of course, inventories were they were born out of the IEA, the creation of the IEA, that every country would have a large certain quantity of strategic petroleum reserve. Your thoughts on the U.S. position there? We're seeing inventories in the U.S. We report again today that the API reports that U.S. inventories are down another 6 million barrels this week. Where is the U.S., you think, going with this or not doing? We're going to do it, we're not going to do it. Strategic petroleum reserve rebuilding in the U.S.
Yeah, well, they put out guidance that once the WTI price was it hitting 70 and heading down or something, they would start rebuilding. That was back above that level now, and they've decided for the time being they're not going to go back into the market and start to replenish the reserve. Well, if I'd been at the IEA when these decisions were taken in the middle of 2022, my private counsel would have been not to get involved in stock withdrawals, frankly, because they were being done for blatantly political purposes. And but there we are. What you should remember is the United States, under the terms of the IEA stock holding mandate, actually isn't obliged to hold much at all because it's not a net importer.
Right.
And the US, and what the other thing that people forget is that long before the Russian invasion of Ukraine, under US laws going back to the Obama administration, the US had decided, partly as a result of the fact that its domestic production had soared, that it would start to draw down the SPR in a managed and careful way over a period of several years, because they didn't need 700 million barrels. It was mandated to come down over a 7 or 8 year period, gradually sold into the market and the money used for other purposes. So, what they've ended up doing by drawing it down in 2022 is in a way what they were thinking of doing anyway, but they've brought it forward for political purposes. And we'll just have to wait and see what attitude they take. But at current price levels, and if Peter is right, and I personally don't agree with his price outlook for the end of April, although not to disrespect that, then clearly they're not going to be buying back oil at those price levels.
Peter, you get the last word this morning. Respond to that, Neil's comment, but also I wanted to get your insights on Japan and the yen and the outlook for where Japan's economy may be going. Of course, one of the world's biggest gets often forgotten, but its big drama of the last year has been the collapse of the yen, but now the yen seems to be on the move as the sort of European US picture weakens.
Well, first off, Mr. Ueda will be the new governor, Sean. He runs, I think, starts in the next couple of days, early April. And we say good sayonara to Mr. Kuroda. Now, where the yen is, you've got around a 132 handle. It's been very choppy over the last month, and that's been great for traders. So if you're looking where it's been in the last 6 months, it's been nothing short of outstanding. So plenty of opportunity, and I think that better than expected inflation numbers. Again, that was a surprise to the downside for Japanese inflation. So as we look there, we could see a further, I'm not expecting rates to ratchet up very heavily in the next couple of months from Japan. So if they can get inflation under control, then that's going to be a good sign. And the next sign, of course, is you could see a little bit further strength to the upside for the yen. Though we've just got to keep a close eye where that US dollar index is. As far as oil, I think the fund's going to be ahead of us. We buried the first quarter and we go into the second quarter, and I think it could be a quarter of surprises, Sean. So yeah, I'm looking the unsettling situation with France, for instance, the unsettling situation with the Kurds, and I think there's enough global surprises that are going to present themselves, and I think that's going to be bid up as far as oil, and keep an eye on gold.
Well, certainly the banking trauma of the last few weeks, you would say, is 2023's black swan so far, and maybe not the same as the Q1 black swan of Russia's invasion of Ukraine last year, but certainly it turns out to be, at least so far, a mini black swan. But the question then is, as Peter points out, will we have a flock of mini swans this year rather than one monster? The no is the response on the survey. So-called banking crisis now past. I'll post that on social to get the views there. But we finished the quarter with Brent crude oil averaging above $80. And speaking to my stakeholders in this neighborhood, everybody's delighted with $80. 80 plus is a happy sweet spot. And if we get that with all the traumas of Q1 in Q2, they'll certainly be happy campers in this neighborhood. And of course, the big moment in Q2 will be that OPEC plus meeting in Vienna in June, which will point to the second half of the year, and perhaps that becomes a bigger question as we move deeper into Q2. Just promoting there an interview we have with Adi Imsirovic on HTT, this halftime talk this week, principally because Adi's just come out with a new book, or is about to publish his new book, which is attacks the oral history of the Brent contract for those who are so interested. But it's quite a unique approach. All of the traders and actors who were there through the 80s and played a part in the early decade of Brent telling their stories. So it's kind of a nice way into that. Thanks, Ole. Really appreciate your insights this morning. Peter McGuire, as always, from Sydney. You can now go to the beach. Neil Atkinson's from Paris. You cannot go to the beach only because it's too far away from Paris. And that's Paris, France, of course. All the best. Have a good day, everybody. Take care. Thank you.
Thank you, Sean. See you, Neil. Thanks, Ollie. See you Sunday, Sean.